Bringing you the latest in tax credit news, this is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the November 22nd, 2022 podcast. This week's episode is another installment in our ongoing So You Want to Be a LIHTC Developer series. We launched this series to help real estate developers get a better understanding of the most successful affordable housing production incentive in the country, the low-income housing tax credit. This series is designed for you if you're a developer interested in using the low-income housing tax credit for the first time. Or perhaps you've recently started a role with a low-income housing tax credit developer, and you're tuning in for an introduction to low-income housing tax credit basics. Or maybe you're an investor or lender who wants to better understand the developer role. No matter what role you play or hope to play in a low-income housing tax credit transaction, this series is meant for you. Our November 1st episode of the podcast looked at location and market considerations when assessing the financial feasibility of a possible low-income housing tax credit development. We will link to that episode and other low-income housing tax credit basic episodes in today's show notes, so be sure to check those out. Also, if you have a particular topic or question you'd like us to address in future episodes of the podcast, please email them to cpas@novogradac.com. We'd love to hear from you. Now, turning back to today's podcast, today's episode deals with a topic that directly affects how much equity a low-income housing tax credit development can receive. We're talking about final cost certifications. Now, we'll get into the definition of a cost certification in more detail during today's podcast discussion, but for now, just know that the cost certification is a critical component of a low-income housing tax credit transaction, a critical piece of the timeline. If you complete your final cost certification in a timely manner and everything else is in place, then your development will likely be funded as anticipated by your equity investor. However, if your final cost certification is not completed in a timely and accurate manner, you will likely be facing delays in receiving some equity contributions, and you could even face a reduction in the total equity contributed by your equity investor. Conversely, a little bit more optimistically, if your cost certification shows more tax credit basis than initially anticipated, you might be eligible to receive more tax credit equity than anticipated, depending on the terms of your partnership agreement, any upward adjusters, and your credit award from the state. Now, in short, delays and inaccuracies in a cost certification can cost you time and money. And limiting delays and ensuring that you capture as much tax credit basis as possible could lead to additional tax credit equity contributions from your investor. That's why it's so important to work with an accountant who's experienced with final cost certifications for low-income housing tax credit properties. And that is a great segue and introduction to our guest today, my partner, Warren Sebra. Warren is a partner in Novogradac's Portland, Oregon office. He is one of our leading low-income housing tax credit experts and helps produce Novogradac's low-income housing tax credit handbook every year. In his work with low-income housing tax credit developers, Warren has extensive experience helping clients navigate the ins and outs of cost certifications. He has plenty of insights, tips, and examples to share with us. Now, I'm going to break today's topic down into 4 key sections. First, we'll discuss a basic overview of cost certifications. Second, we'll share some examples of costs that are included in tax credit basis, as well as costs that are not included. Third, we'll discuss some approaches to calculating tax credit basis that boost eligible basis that many developers aren't aware of. Fourth, we'll wrap up some additional tips and recommended practices that developers should know about final cost certifications. So be sure to listen through the end. We have a lot of ground to cover, so if you're ready, let's get started. Warren, welcome back to Tax Credit Tuesday.
Thanks, Mike. It's great to be here.
So let's dive right in. As I mentioned in my introduction, this is a series about low-income housing tax credit basics. Many of our listeners might have little or no direct experience with low-income housing tax credit cost certifications. So bearing that in mind, Warren, could you please explain to our listeners in more detail what a low-income housing tax credit cost certification is, and maybe more importantly, why it's important?
Yeah, thanks, Mike. When I get a call from a new developer or a new person looking at affordable housing and specifically the low-income housing tax credit, this is one of the first questions they ask. I've heard about this cost certification. What is it and why is it so important? I think first, it's important to know that the cost certification is an audit of the uses of the construction cost. Sometimes states will require the construction sources and permit sources on there, but the real important thing is an audit of the uses of construction. And that audit will help calculate what's called eligible basis or EV tax credit basis. And from there, that tax credit basis and the final cost certification is going to be submitted to the state allocating agency. And also your investors are going to be required to look at that as well and to approve it. And when it's submitted to the state allocating agency, you kind of it's for the 8609s. And it's kind of the key that unlocks those 8609s. There's a lot of other things you submit to the allocating agency, but the final cost certification is one of the most important documents to prepare the 8609s. And when you have those 8609s, it's kind of like your golden ticket to claim credits. You'll be able to claim those credits on your tax return. And also it triggers a capital infusion to the property. And your investor will have certain benchmarks that need to be met before you receive all of your equity. Typically at closing, you may receive between 15 and 25% of your equity, but then the benchmarks will have to be met to receive the rest of your equity. And receiving a certified cost certification by an accountant is one of those benchmarks, along with the 8609s from the state.
So thank you for that overview. The cost certification is certainly a critical benchmark, as you noted, to receiving at different stages. One of the stages or a few of the stages is your anticipated equity contributions. So maybe for listeners who aren't aware, at what point in the development process is the final cost certification submitted, and to whom is it submitted?
Great. When I look at the process or the phases of a development, I look at it in 5 different phases before development's closed. First, you have your pre-development where you're hiring an architect, contractor, find an investor. You're closing where investor actually comes into the deal and your lender. Then you go out and construct. Then you have initial lease up, I should say, and permanent financing. So those are kind of these 5 phases before you actually operate the property. And generally your cost certification is going to start after construction and before permanent financing, because it's going to trigger the equity infusion that will help lead to perm financing. So that's when it will take place. And it's submitted to the state allocating agency. Every state has one, and it's submitted there. And it's also, delivered or submitted to your investor for approval. Sometimes lenders might want to see it as well, but the investors and the state allocating agency are the key players that will look and review that, provide comments, and ask questions about that document.
And in terms of the completion of the cost certification, when it's completed and submitted to the state, how often do the equity investors, upon completion of the cost certification, but before and upon submission to the state, before the state actually issues the IRS Forms 8609s, how often do investors give a capital contribution based upon completing the cost certification? And how often do they give an additional equity contribution when they get the 8609s and the transactions that you work on, would you say, just roughly?
Yeah, I mean, I think those are 2 key benchmarks. Sometimes they're separate, sometimes together, but I find that they're separate. And, there could be, hey, upon receiving the final cost certification, you get another tick of the equity, and then 8609, another infusion of capital. I think that's important to recognize that there could be 2 separate benchmarks there, even though they kind of are talked about together. Oftentimes they're separated because they want to encourage the developer to get those things done, because it's important for their credits delivery to have those 8609s. The final cost certification is not the end all be all. You have to receive those 8609.
This has got to get into the bit of the weeds, and this is basics. But one issue that, has always been around ever since the cost certification requirements were in effect is a state agency oftentimes wants to know what the permanent financing is going to be so that they know they can judge whether the maximum amount of permanent financing has been obtained, because they don't want there to be too much cash flow. And they want properties to have enough cash flow to deal with potential headwinds over time, but they don't want the property to have too much in the way of cash flow. because if there could be more permanent financing, then that could cause the state to not to allocate as much tax credit. So they then could allocate the credits to others and create more housing in their state. So there ends up being this tension between the permanent lender not wanting to loan until the final equity contributions are in place to fund the gap, and the permanent lender not wanting to lend until the 8609s are done, but the state agency wanting to see what the permanent financing is going to be before they issue the 8609s. And what's been your experience on that front? And it's a relatively technical area, so maybe you just want to punt to a future podcast.
Well, it is relatively technical, and I would say some states do things differently. So it's really important to kind of understand your state processes. I know a lot of states are really concerned about, matching up perm financing and making sure it's accurate as possible. Whereas in reality, sometimes you don't quite know what it's going to be. And it's a matter of submitting that correctly to the state so they can understand, because it could be a key issue. And especially a lot of times, some of my developers I work with, they don't submit until financing has been secured, just because they know the state is looking for that key indicator and they want to know what it is exactly. And so some of my developers do wait to that time, and that's key to understand, know your states.
That's certainly one of the themes here is you definitely need to know the rules at the federal level, but you also have to know the rules at the state. And we interchangeably say state or credit allocating agency because there are, some cities, 2 cities that are their own allocating agency, but we won't get into all of those details. But we oftentimes say state, but we conceptually mean credit allocating agency, but most of them are states. And then of course there are possessions, but now I'm going off on tangents.
Excellent point, Mike.
So to provide context for our listeners, maybe you could describe the role of the accountant. You're obviously an accountant and a CPA and perform lots of final cost certifications. What is the role of the accountant with respect to a final cost certification?
Yeah. The key role is to be an auditor, right? We're auditing these costs and delivering an opinion on that the state and investors and the developer are relying upon. So that's a key thing. But we also are there to help assist the developer know what we're doing and why we're doing this cost cert and why are we moving things in an eligible basis and tax credit basis. And that's kind of what I see. Often people know what an audit is, but in relation to how we're taking the cost and then also taking the cost of the developer, calculating an eligible basis. And that is where I like to assist my developer clients in helping them understand what eligible basis is and how we get there and how important that is to be accurate and have good records to help us get to the correct answer. And from there, then it becomes a product that, the developers can use and we can go on and submit to the state and send to the investor.
So what are the general responsibilities of the developer in ensuring that the final cost certifications are done as efficiently as possible?
Great. The first thing is hire a CPA, right? We talked about what our role is. And I think you want to think about that at, closing, and certainly so they can have some consistency and have your CPA look at maybe your financial forecast and give some kind of consulting on, hey, do this or that, because when you close, your investor's going to do a forecast and they're going to estimate eligible basis. And you want to be able to know that, hey, when you go do the cost cert, that it's going to be consistently interpreted by your CPA and understand where the key points are in calculating eligible basis. So that's one thing, hiring a CPA, but also keeping accurate records. And that really enhances the allocation process and speeds up the process so the CPA can deliver a product in a timely manner for the benefit of the project.
So with that in mind, obviously I have my recommendation. But what's your recommendation as to what point in the planning or development process advisors should start thinking about the cost certification?
There's a thing that we hear a lot oftentimes in business. I think Stephen Covey may be the first one who talked about it, but beginning with the end in mind I think is a key concept with this cost certification and with your LIHTC development. You want to understand the process and where you're trying to get to. And if you are closing a affordable housing project with an investor and you haven't thought about the cost cert in a year and a half to 2 years, you're going to be in a world of trouble because you're not going to deliver in a timely manner. Because you have to keep records and invoices and schedules to help your accountants to perform the audit correctly to give that opinion. And so if you're not worried about that when you start to closing, and beginning construction, your records aren't going to be accurate or they'll be disorganized, and delivering that to your CPAs for their audit review is going to be difficult. So you should be thinking about it the day you start your pre-development and keeping accurate records, and so you can deliver those cost certs when needed.
I mean, in terms of the different categories, you would say on the one hand, make sure a lot of work is done in estimating tax credit basis. So you're capturing as much of as you can, and then ensure that you're in the course of the development, retaining records that are more readily auditable. So that's for all great tips.
And I also just would, a quick tip, Mike, is I see a lot of people being very aggressive at the forecasting phase with eligible basis, and that could put you in a world of hurt because when you do the cost curve, if it's off from your estimates, it means you're getting less equity from your investor. So it's important to understand when you can increase your eligible basis during the forecasting, because that affects what the projected equity is.
No, that's a good advice, good caveat. So I touched on this a little bit in my introduction, and it's obviously a situation every developer wants to avoid, but could you explain in a bit more detail, what can happen if a final cost certification is not completed and submitted on a timely basis?
Yeah, absolutely. And we hinted about this in one of the first two questions about benchmarks. So in your limited partner agreement, it's going to list out 4 or 5, maybe 7 or 10 benchmarks you need to hit to receive your equity. And if your cost is one of those benchmarks, it becomes a timing issue, right? When you deliver that. And if your records are not adequate and you deliver those in a disorganized manner to your CPA, it's going to be very challenging for the CPA to unravel that and deliver it on time. And there's going to be some delays that could be detrimental to delivering that cost cert, because you're trying to get to perm closing, right? If you're delaying perm closing, you could have extension fees or increase your cost, and then, increase interest costs, because construction interest is generally higher than perm loan interest. And so you want to get to that point and save your project money by delivering that cost cert on time. Because remember, the cost cert is going to be the key to deliver those 8609s. And the 8609 is going to be a golden ticket for claiming those credits.
All good points. And I would just layer on that when you are negotiating with an investor for capital contributions, you definitely want to work with the investor to give you a capital contribution when the cost certification is done. And I say that because some states can be a bit delayed in processing 8609s. And when you're waiting on a large capital contribution and your wait in a state's getting delayed, it can be very frustrating. And obviously every day that goes by that you don't get your equity contribution is a day more of interest expense. And when interest rates were really low, it wasn't maybe as much of a adverse effect, but with higher interest rates, the delay in getting the 8609s from a state can have an adverse effect on development, particularly when a large equity contribution is contingent on that. So let's move on to additional cost certification basics. So we know getting a cost certification done correctly in a timely manner is very important. I want to talk now about some examples of eligible and ineligible costs. When I say eligible, I mean eligible to be included in tax credit basis, and ineligible meaning they're not eligible to be included in tax credit basis. And I will also note, as a general caveat with respect to this, many transactions are using allocated or 9% credits. They'll get a set credit amount award. And if their costs end up, their tax credit basis is rising above that number, they generally won't get more tax credits. Now, there are situations that we've faced with cost overruns and the rest where there are substantially higher costs and they get a supplemental allocation, all the rest. So it's not unheard of, but it definitely as a general rule, you don't get additional credits if your eligible basis exceeds the minimum level for qualify for the full amount of your award. It's a 9% allocated credits. There might be other reasons why you want to have additional costs, but we'll save that for a 202 on another podcast. But with respect to bond transactions, and that would be the credits that come along with financing 50% of your land and building with private activity bonds, they're generally speaking, every dollar of additional tax credit basis does turn into additional tax credits. So with that as just a general, maybe level setting for the newer listeners, I also wanted to note that the IRS provides guidance as to what's includable in eligible basis. So we have this discussion about examples of what's ineligible and ineligible costs. Ultimately, the IRS ends up providing guidance. If you disagree with the IRS, you can go to court, but nobody goes to court and disagrees with the IRS. There's a default that the IRS guidance that is out there is generally what investors will use in terms of what's included in eligible basis. That said, many allocating agencies have rules or procedures that limit what can be included in tax credit basis for purpose of them awarding credits. So it means that on a given development, you have to look at what the tax credit basis is from the IRS's perspective and what the state will award on. And it's a lesser of those two. So you have to, it's the least common denominator. So that was a bit of a lengthy introduction to a question. So I apologize, Warren. I apologize for our listeners. I did want to do a bit of level setting as we start to talk about, costs being included and not being included. So let's start with some examples of costs that do, generally speaking, get included in a cost certification, or I shouldn't say included in a cost certification because all costs are included in cost certification. It's the costs that are included in tax credit basis as part of a cost certification.
All right, Mike, thanks for clarifying that, because each state will have a form, right? And some states are more particular about what form they use. So I haven't mentioned that. I just want to mention that. Make sure you know what form you use, because it'd be very frustrating to deliver a form to the state and it'd be the incorrect form. So make sure you're using the correct form, but there will always be a column of total construction costs and a column for eligible basis. And so we're talking about that column for eligible basis or tax credit basis. And so a lot of things that are included. I like to look at this as that the code is kind of designed to capitalize more and expense less. And for LIHTC developers, that's great. So there's a lot of ways to capitalize your costs, including an eligible basis. And so hard costs are costs of construction, like your contractor costs, the cost to build it are included in eligible basis. Direct soft costs, like architecture, engineering, included in eligible basis. Soft costs also during construction are included during the eligible basis. Soft costs can include interest, insurance, taxes, amortization of loan fees, things like that. There are quote unquote indirect soft costs are included in eligible basis. There are obviously some very things to think about when you're determining eligible basis. That could be for a podcast 202, right? So it's important to kind of, if you have issues in your project and you're not sure what should be included in eligible basis, to contact your advisor, seek out your accountant so you kind of understand there, because there's a lot of nuances. But those are the key things that I look at for including eligible basis: hard cost, direct soft cost, and indirect soft cost.
And kind of broadly speaking, when we think about the hard costs, we're thinking about costs that are depreciable.
Right.
As a kind of like the initial sort of bright line test in terms of costs that end up getting included. So depreciable costs are the bright line test of costs that get included. So what are some examples of costs that generally are not included in tax credit basis?
Right. Or costs that are generally not depreciable, right?
Right.
That's where you start with, right? So costs are not depreciable. The obvious one that I always point out is land. So your land costs are not included. It's a key thing to remember that your acquisition cost oftentimes can be. So when you're acquiring a property in an AC rehab, land not eligible basis, acquisition can be in your depreciable basis and can be included in the eligible basis at times. Most of the times it is. So land, when I think of land, there's you say, well, what is land? Land is what you pay for the land and also cost to improve the land. And that can be a little murky sometimes, especially with your remediation. And I look at it as if you're improving the land, then this actually costs the land, not to the building. And I remember real quick, Mike, a story I had doing one of my first cost certs when I was a staff accountant, looking through all these invoices, not understanding what was going on and reading them. And the line item said removal of human remains. And I said, what am I looking at here? And it turned out that what it was unbeknownst to the developer, they had started developing on a Native American site, and they had to remove those human remains to a different location. And we had quite the debate of where these should be. And at the end of the day, with the council of, the code and the developer, we decided, hey, that's really improvement in land. And because whatever building you put on that, you would have to have taken care of those things if you want to build on that property. That's kind of how I look at it with land, is if you have to do it to any any building that goes on top of that land, oftentimes it's a land improvement, and those don't get included in the eligible basis. And that could be a very significant cost, right? Especially in states on the east and west coast where land value is very significant. And so that all those costs would not be included in the basis. And other small costs like commercial costs, if you have a commercial space in your building, those costs would have to be allocated out of eligible basis. And things like reserves that are in your capital stack, operating, replacement reserves, any debt service reserves. And, you don't think of those as construction costs, but they're going to be a cost of the development because they're going to be financed by permanent sources. So that's why you'll see reserves on your cost chart, because states want to see what your permanent sources are going to cover, and those reserves will be funded by your equity contributions or from your lender.
No, thank you for that overview. I like to think of it as you've got the buckets of costs that are easily determined, land, the wood for the framing and things of that nature or I should say wood for the framing of the units that are going to be used by the tenants. But you have the first layer of cost, then you have a lot of soft costs that then get reallocated among various qualified and non-qualified categories. So there's definitely a lot more tiering that goes on in the course of the cost certification process. That's once again above and beyond the purposes of this podcast. I did want to cycle back for a moment to deal with the fact that tax credit properties, one of the benefits of the loan for the tax credit is that developers can readily layer in other tax credits and or government debt financing. For example, many acquisition and rehab tax credit properties also qualify for historic tax credits. And regarding government debt financing, many tax credit developments also receive financing from the Department of Housing and Urban Development, or HUD. These additional sources often have cost certification requirements as well. So could you discuss some of the situations where additional financing sources necessitate additional cost certifications and how that gets layered in, timing of preparing the cost certification that'll be submitted to the state housing agency?
Yeah, absolutely. And, right now I'm working on a few projects that we call quote unquote a twin deal, meaning that you're using two different credits, historic tax credits and local housing tax credits. And it's important to clarify one thing is on LIHTC side, that cost cert has been submitted to the state. An historic tax credit cost cert, oftentimes it's not submitted to a state agency. More often than not, it's not. It's more submitted to an investor. But your investor is invested in historics and LIHTC, and so they may require a cost cert for both. So it's important to figure out what schedule you're going to use. And because for the state housing agency, they're kind of not really concerned about the certification of the historics. They want to see it in the calculation of permanent financing and construction financing, but in terms of it being there and certified by the CPA, they're not concerned about that. So you have to come up with a form that's going to correctly deliver a product to your investor that they will be sufficient for the investor. So oftentimes you might have a supplemental schedules or include it in part of the LIHTC cost certification. Sometimes investors might do two separate ones, separate LIHTC and separate historic cost certification. So it's important to kind of understand that and know what you're dealing with when you deal with a cost certification on a twin historic LIHTC deal. With HUD, oftentimes HUD has what's called a mortgage cost cert. But with LIHTC, there's an exception. If you have a LIHTC property, oftentimes you can waive out of that certification and that final cost certification. You may have some other things called a contractor certification that you have to do if you're a related party contractor doing a HUD project. So it's important to say, hey, do you have a HUD project? Do I have this cost certification requirement for HUD? If it's LIHTC, probably not, but you may have some other requirements to submit to HUD if you're a related party contractor. So be careful of that. Some states also might require a special mortgage cost certification. Be careful about your state requirements, because there are some that require, and it can be quite cumbersome to figure out what they require, but they do require. So be mindful of that as well.
So thank you for that. There's a lot more we could talk about there.
Oh yeah.
We'll keep moving here.
Okay.
So there are some ways to enhance eligible basis that many listeners may not be aware of. And ideally, a developer incorporates these approaches at the very beginning of development. In that way, they can include as much of the additional tax credits that they will ultimately be eligible for in the associate equity financing and their initial budgeting, their initial forecasting. With that said, could you share a couple of the ways that developers can increase tax credit basis that are less a function of classification of costs, but more a function of accounting methodology and the ways in which Section 42 operates.
Yeah, and real quick, I just want to mention, the DDA and QCT, because that is a 30% basis boost. And so that happens at the planning stage, meaning the location of your project could give you a 30% boost. A lot of developers know about that. I just want to mention that's a way to boost your project. A lot of projects do qualify for that. So keep in mind the 130% boost could enhance your eligible basis. But on the technical accounting side, I think we look at what's called a TAC pack rule, and this would apply for rehab projects where you're allowed to start taking, and it's important to realize your acquisition and your rehab credits are taken concurrently in the same year. So you may acquire your property a year or so before you complete your rehab, but what the tax back rule allows you to, under certain circumstances and following some technical rules, and we won't get into the minutia of that, but if you follow the rules, you can go back the date you acquire your property to start claiming eligible basis. So for example, if your rehab was completed in November of 2022, but you purchased a property in May of 2021, in theory, it's possible if you have lease up and you have tenants that are in the project, you could start claiming your credits in January of 2022. So that's a rule that you really have to be aware of when you're doing an acquisition rehab project. It's quite complicated because it involves keeping track of the units that are leased up. And sometimes when you are doing ac rehab, there's tenants moving in and out of units and changing units. So it takes a lot of planning consideration to make sure you are doing the best way to enhance your credit delivery to your investor. And as we talked about before, if you have increased basis delivered, you get more equity, and that capital infusion can really be a benefit to the project. And another would be 263A, the avoided cost, where you can make an election to take your operating cost and capitalize it to basis, and therefore include an eligible basis. So those are kind of two other factors. Just curious, Mike, do you know of any other things?
Well, I think those two are probably enough for our listeners, at least whet their appetite.
Okay. Well, okay.
And I just would say that, rather than talk about some additional methodologies or different additional ways in which credit basis could be enhanced or tax credits could be enhanced, I'd probably just emphasize the fact that this is something you do want to include in your original projection. Because like when you mentioned the tax back rule and the ability to start claiming credits earlier in the year, that will lead to a lot more credits in the first year of the 10-year plus spillover credits, year 11 credit stream. And you want to ensure that your investor sees that schedule, because they'll end up being able to pay a slightly higher equity price. And then similarly on this avoided cost capitalization rule, the substitute cost rule that can increase tax credit basis, you want to get that in to the initial estimates. So once again, you're projecting a higher tax credit basis, and then when you apply for the state for credits, you can potentially qualify initially for more credits and get your investor to commit to buy the additional credit at the beginning. So let's now move on to more of our sort of tips and recommended practices portion of the topic. There's a lot of tips I know that you have for developers with respect to cost certifications, but maybe you could just share a couple that you would think, okay, this is something that if I only name 1, 2, or 3 top cost certification tips, this is what they would be.
Yeah. And this one tip that I have, it's based upon many years of experience. Oftentimes you'll see in the accounting department, they'll have an accountant over development and an accountant over, operations. And development, the person over accounting development might be the developer themselves. And they'll keep a schedule of all the development, but it won't be recorded in the general ledger during that time. And then they'll record all the adjustments, 2 years after the development. What that leads to is just confusion, meaning that it's like, okay, what was this transaction that happened, 18 months ago? So I think the tip is to kind of, it's okay to have your development on a spreadsheet. A lot of developers use that to keep track of each draw. That's perfectly fine, but to find a way to have that included in the general ledger and record it correctly. So when sometimes in a cost certification, it's clear what took place. Because there's just transactions that happened, you just might not remember, 18 to 2 years ago when you started doing the cost cert. So that's one tip, is to try to merge that into a general ledger as soon as possible. Sometimes it's more difficult than it can be, but it's worth it if you're trying to deliver that cost cert on time. Also, another tip is it's kind of self-serving, but I think it's important is to keep your accountants up to date on the project. And if there are transactions that occur, especially at the closing, that are quite unusual, that might need some clarification on the accounting side. And because oftentimes you'll see it's not told to the accountant. And then when it comes to record at the cost verification time, there's things that might need to be explained and changed where that wasn't the situation back in 2 years ago. So I think letting your accountant know about those unique transactions before the cost certification is also a key point.
So I don't like talking about negative things, but I will break that rule. When talking about negative things, we'll avoid negative things. Maybe you could discuss some common pitfalls for developers so those listening can learn from others and learn vicariously as opposed to learning from their own personal experience.
Yeah. And I think a common pitfall is if you're an experienced developer and you're jumping into LIHTC development, you may have an accountant you've used often, and you need to make sure that accountant is experienced because it could be a quite hard thing to learn at first. An experienced accountant to do a cost cert is really important because it's a very unique niche, and to have someone experienced is really, really important. But also, I think the pitfalls is what I talked about in the earlier tips is not having adequate records. Because remember, this is going to be an audit process. And so you need to deliver a quality documentation to your accountant so they can efficiently do the audit. And if it's not delivered in an efficient way, it can lead to delays in that delivery of the cost cert. So that's what I would say is back to my original thing is having adequate records kept so you can deliver it to your CPA and they can get started as soon as possible.
And I guess I would just build on that by emphasizing your point about working with experienced CPAs. Just like we say, you should work with an experienced attorney who's experienced with law commencing tax credits. And if it's tax and bond financing too, then an attorney that's experienced with both, not just one of the two. And then your attorney should be, your accountant should be, but it also go beyond saying an accountant should be experienced with the law commencing tax credit. They also should be experienced with the state rules for the law commencing tax credit. Because as you asked, there's a number of idiosyncrasies that states have for a variety of good reasons. They are idiosyncrasies and they are different. And the more parties you have who are experienced in the state, the less likely you are to hit a roadblock. And I'm not saying you won't hit a bump in the road because states are changing their rules and all the rest. But if you have a number of experienced parties involved, then you're going to anticipate a lot more of those road bumps. And when you do face them, you'll be better situated to be able to strategize to get around them or over them. So it's definitely something where experience pays lots of dividends.
Excellent point about the states. Well said.
So thank you for that, Warren. Now, before we close, I wanted to know if there's anything else that we haven't covered that you thought would be important to add.
Wow. Like we said, we can definitely do a 202 class. I think it's really important to understand what a cost cert is, figure out what eligible basis is. It's really, really important. Nothing specific, but just keep in mind that this is a process that is not easy the first time around, but once you do 1 or 2, 3 or 4, it becomes easier and more understanding and knowledge is gained.
So thank you for that. Anything else you wanted to share before I bring the podcast to a close? You can't leave though. I do have questions to ask you, but
yeah, sure. No, I'm not going to leave. Yes. I think in 2 weeks, we're all going to be in Las Vegas and we're going to attending the tax credit housing finance conference, which is December 1st to the 2nd. And there's going to be plenty of discussions on eligible basis, final cost certifications, networking between developers and, investors, stuff like that. And also a personal plug, I'll be doing a workshop on November 30th about running the numbers, which is before the actual forecast. So if you'd like to join me with that, I'd love to have you. And we will go over model affordable housing transaction and go into a deep dive of how to calculate the tax credits and how to calculate eligible basis and specifically how it relates to underwriting process.
Great. Thank you, Warren. I will link to the conference in our show notes. And I do encourage listeners to contact Warren directly with any questions about their specific developments. I'll include Warren's contact information in today's show notes as well. which can be found at www.novoco.com/podcast. Next week's episode is slated to continue our So You Want to Be a LIHTC Developer series with an installment about operating expenses and income. Two members of Novogradar's valuation team, Blair Kinser and Kelly Gorman, will be my guests. Blair is a partner in our Washington, D.C. office, and he specializes in market analysis and appraisal of various types of mixed income and affordable housing properties. Kelly is a principal in our New Jersey office and has extensive experience performing appraisals, market studies, rent comparability studies, and consulting services for a broad cross-section of clients in the loan-to-value tax credit and supportive housing industries, including developers, lenders, syndicators, property managers, and state agencies. They're going to help us better understand operating expenses and income. And this is at the results of a survey that we do every year. You're familiar with our operating expense and income report. And every year, I'm always interested in seeing the results of the survey and seeing how operating expenses have been trending both on a year-to-year basis, but more importantly, we're a 5 to 10 year basis. And then similarly, I'm always interested in seeing how income is changing on a year-to-year basis, as well as over a 5 to 10 year basis. This has been particularly useful during this COVID period, where we've been trying to identify what the impact of COVID has been on both operating expenses and operating income. And then, of course, as we reach a more inflationary environment, how inflation weaves its way through operating expenses, as well as shifts in median incomes and allowable rents. So there's going to be lots for us to talk about, and I do hope that you'll join us. You can make sure that you're notified of next week's episode and each week's episode by following or subscribing to the Tax Credit Tuesday podcast. Go to www.novoco.com/podcast to subscribe to and stream the show on our website. You can also follow or subscribe to Tax Credit Tuesday on iTunes, Spotify, Google Podcasts, Stitcher, Radio Public, and now on YouTube. Please leave a review. That helps other people find our show. Now we reach our off-mic section, where I am able to ask our guests some off-topic questions to get some off-topic advice and words of wisdom from our guests. So Warren, one of my favorite questions for podcast guests, and I presume I've not asked you this before, what is your favorite podcast? And it goes without saying, you cannot say Tax Credit Tuesday.
Okay. Well, in baseball season, I have several, but that's a very specific niche. Baseball season is over now, but daily podcast I listen to quite often is called The Journal. It's from the Wall Street Journal. And it's like a 10 to 15 minute news story. And it's perfect because my commute to and from the office is 15 minutes. And so I can just get a quick little synopsis. It's not the news of the day. It's just one little story or news story that they go over. And it's quite interesting. It's generally about topics that I probably wouldn't have read about. And so it's good to kind of get that little bit of a news story.
And it's roughly 10 or 15 minutes on one topic.
Yeah.
I really like that. Is there a recent topic that comes to mind that you found interesting?
Yes. As you know, I'm from Portland, Oregon, and the headquarters of Nike are here. And so there's a lot of sneakerheads that are around. And they recently did a podcast about fraud, which is interesting to me as an auditor, about the sneaker industry and how Nike will sell, 50 shoes in one day and people will buy and then resell. So about the resale market and fraud that happened in the resale market with some sneaker shoes. So that was interesting to me.
Interesting indeed. So another question that, as someone who travels a lot, I love asking guests so I can learn and put them to use myself. So this is, a question that oftentimes I get tips that are really helpful for me personally. With next month's Tax Credit Housing Conference in mind, is there a travel tip that you'd like to pass along to our listeners?
Yeah, I thought about this a lot. Like what tips that I have found, and I think one that I have done last 6 to 8 months is to use taxis when I'm at the airport. And the reason why is I have found that with the ride sharing programs, oftentimes they're more expensive from the airport. Obviously, ride share apps are very useful for a lot of different reasons, but to and from the airport, I have found that taxis are one, more efficient in your time, and also oftentimes the same price or cheaper than the ride share apps that are out there. Because one of the advantages of the taxis is you get out of the airport, they're all lined up. Whereas an Uber or Lyft, you have to call them. So they say, hey, it takes 2 minutes, whereas reality is 10 minutes. So I've gone back to my taxi use especially in the airports when I'm traveling. But I'm curious, Mike, you're a prolific traveler, more so than anyone I know. What are some of your travel tips that I can apply to my routine?
Well, I'll start by saying I do like your point about the taxis because as you mentioned, now with the way in which ride sharing's work and the rest and the extensive use of ride sharing led to a decrease in demand for taxis. So now I suspect that your average wait time for taxis has dropped so dramatically. So that's something I'm going to have to think a little bit more about in terms of my traveling. So I'll definitely, put that tip to mind. But, for me, the sort of number one travel tip really isn't a travel hack or anything. It's more just, when you get to the airport, be prepared to be late, be prepared to deal with delays, be prepared for lines and all the rest. And, I like to say, pack your patience. And, for years of traveling, I wasn't the best at packing my patience. And then there was one trip that I had where I ended up, and this could even happen today. This is back when airlines could do things like this and it wasn't, people didn't object quite as much, where I ended up flying to San Antonio and the plane got diverted because of thunderstorms to Austin. And we got to Austin at like 1 or 2 in the morning. We stayed on the plane until 4 or 5 in the morning or something. And then we flew on to San Antonio. So we never got off the plane in Austin. And then I got to San Antonio and it was, it was at the morning. And then I got to the hotel and I couldn't check in yet. And then I went and spoke at the conference I was there to speak at. So needless to say, I was tired by the end of the day, but it was just at some time during the night, sitting in the airplane in Austin, I sort of came to grips with the fact that I just had to kind of go with the flow. And ever since then, I've made sure to pack, basically pack to be able to deal with delays and be functional. So now wherever I am, really your office is with you. So I'm able just to go and not be so focused on, are you on schedule? Are you not? It's more, I'm here and available. So when you're ready for me, I'll get on the plane. When the plane's ready to take off, I'll be ready and not be too focused on, is there a delay? Is there not a delay? And just be a little more mindful. And as a consequence, use the time more effectively. So it's not really a hack. It's really an approach. It's a mental outlook for travel, but it's definitely one that has done me very well. And as a consequence, the travel can be a lot more productive and more enjoyable.
Yeah. That's a great approach, Mike. Great approach.
So thank you for that. And thank you again, Warren, for joining me. And once again, to our listeners, Warren's email will be in our show notes. So please feel free to reach out to him. And also to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes. You can find related links referenced in this podcast in our show notes at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.